Most people believe a late payment is simply a mistake, a moment, an inconvenience, something that fades quickly once the account becomes current again. But the system does not measure moments. It measures weight, and it measures time. Inside behavioral signals, once on-time consistency is broken, the next question is not whether you recovered. The next question is, how severe was the break? And how recent was it? Severity and recency are not emotional judgments. They are probability markers. A 30-day late payment signals interruption. A 60-day late payment signals escalation. A 90-day late payment signals sustained instability. Each progression carries increasing interpretive weight. Why? Because time reflects persistence. 30 days late may suggest a temporary disruption. 60 days late suggests the disruption continued. 90 days late suggests difficulty restoring stability. And the longer instability continues, the more predictive weight it carries. Severity is not about punishment. It is about duration of deviation. Now consider recency. A late payment from 5 years ago is not interpreted the same way as one from 6 months ago. Time changes weight. Underwriting models gradually discount older instability, but recent instability is treated as active signal. Because lending decisions are forward-looking, the system is not asking who you were. It is asking who you are likely to be. If a late payment occurred recently, the model interprets that as current risk. If a late payment occurred years ago and stability has been uninterrupted since, the model interprets recovery. Recovery reduces risk. Recency increases it. Now combine severity and recency. A single 30-day late payment 3 years ago carries limited weight. A 90-day late payment 6 months ago carries substantial weight. But there is another layer. Clustering. 2 30-day late payments within the same year signal repetition. Repetition increases perceived instability. A 30-day followed by a 60-day suggests escalation. Escalation suggests trend, and underwriting models are built to detect trend. Trend increases uncertainty. Uncertainty increases pricing and scrutiny. Stability reduces uncertainty. Now, here is something important. When an account becomes current again, the score may improve, but the behavioral memory remains. Severity does not disappear instantly. Recency does not reset overnight. Weight fades gradually through uninterrupted months of stability. This is why rebuilding requires patience. Not effort alone, but time. Uninterrupted time. The system needs evidence that instability has ended. And evidence in lending is measured in months, sometimes years. Consider 2 individuals. Both are current today. Both have similar scores. One had a 60-day late payment 8 months ago. The other had a 30-day late payment 4 years ago. The system does not see them as equal because one shows recent deviation, the other shows distant recovery. The longer the uninterrupted stability following deviation, the more confidence rebuilds. Confidence compounds with time. Now understand something deeper. Severity and recency act as multipliers. A severe event that is recent carries the highest weight. A minor event that is old carries the least. This is mathematical modeling, not opinion, not narrative. Probability weighting. And probability is the foundation of lending. Before a lender evaluates how you pay, before they examine balance patterns, before they consider reporting timing, they evaluate how serious instability was and how long ago it occurred. If the deviation was minor and distant, progression continues. If it was severe and recent, interpretation tightens. This is not personal, it is predictive. Understanding this removes confusion. It explains why someone can feel better financially, yet still experience hesitation in approvals. Because the model sees both improvement and recent instability. Improvement is positive, but time is required to strengthen confidence. Severity and recency sit directly beneath on-time consistency. They determine how heavily deviation is weighted, and they shape the lens through which the rest of your behavior is interpreted. Once severity and recency are understood, the next layer becomes visible. Not just whether you paid, not just how severe deviation was, but how consistently you pay within each cycle. Because after stability is restored, rhythm becomes measurable. In the next episode, we will examine payment cadence and how the timing of your payments begins influencing interpretation once reliability has been re-established.